Hey everybody, this is Jim at SP500chart.com. It's about 6:40 on Sunday, early evening, June 15th, 2014. We're going to take a look at the chart of the S&P 500 after I remind you that the website and this video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I control lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I am just a guy who draws lines on charts, so let's take a look. Okay, we did what I'm going to do here earlier in the week, but I'm going to do it again because I think it makes sense to do this. You'll recall that we were in this 13-week-long protracted consolidation pattern that after a while sort of revealed itself as an inverted head and shoulders. There would be the left shoulder, head, and true to form of what we've seen over a number of these patterns over the past couple of years, it looks like a little bit of a short right shoulder. All right, so if we look at this pattern and we examine it, we measure the depth of the head from the neckline. And remember, the neckline is drawn on the for an inverted head and shoulders pattern. It's drawn from the 2 points that define the move or the dip on either side. Here's the left side. We dip down, then we come back before we dip down into the right shoulder. So we have a left shoulder, head, and right shoulder. Now, you might say, why do you call it a head and shoulders? Well, when it's inverted, and that's mostly what we've seen in the markets because we've been in a bull market. When it's inverted, you see it would be like a guy at the South Pole looking over a wall. Here's a shoulder, here's his head, and here's his other shoulder. Typically, this pattern was defined originally as a head and shoulders top, where you have the exact mirror image of this on the horizontal plane. So you would have a left shoulder rally, a head rally, and then a right shoulder rally. But since this is an inverted pattern, everything is upside down. So we break out, we measure our target. It turns out our target is approximately 1990. We establish a channel that is rising up to what it appears to be that target. But this week we're down. We're down over the week. We were up on Friday. I believe we were up marginally on Tuesday, but for the week we were down from about 1950 down to about 1935. Nothing much, less than 1%. Now, the question is, I think you could legitimately and probably rightly say, one of the questions is, are we going to make 1990? Because that's not a given. It's a very high probability because of the pattern that we've come out of. But is it an absolute certainty? Absolutely not. These patterns do fail. They tend, however, to work out at least 3 times out of every 4. And if you'll use your memory and go back to what we've been doing over the last 3 years or so, starting with the YouTube channel and then with SP500chart.com, you'll know that we really have only seen one that we could say, quote, failed, but it later righted itself and worked. So, 1990, still very much the target. The question is, how far are we going to dip down before we find a little bottom and then we start to move back up to make that target. I don't think we're going to go too much further, and I'll tell you why. Two reasons. One is the fact that the nature of this little slide simply has not been very tumultuous. This has been a lazy, it's looked and felt like a pullback. That's the first reason, and if you want to say that's 1A, 1B is, if we look at the chart here, you can see that that we were sliding down, selling increased on Thursday, but then we started to rally back on Friday. Now, I mentioned that the selling on Thursday, and I mentioned this on Thursday afternoon, took the shape of a small descending wedge. And the idea would be, at the time we closed still inside that wedge, the idea being that if that I would take getting over this top line right here as signal number one, that a reversal of this little slide is in the works, meaning we would start to rally again. But signal number two, and I'm going to reposition this line again just to make sure I got it right. Signal number two would be getting over this line right here. And you can see that after we got over this line, we came up, made a little sideways motion, then we rallied exactly. Now remember, this line is drawn from this little peak and this little peak. There you have it. We came up almost exactly to this line and then sold back a few points. Again, we're talking about only about 3.5, maybe 4, not even quite 4 points now between this line and this line. So if coming into this week, starting with trading on the 16th, if we get over this line early on, then I would be willing to say there's a good indication that we are likely in the formation of a small reversal pattern to take us back up to challenge the 1955 high. And I guess, to make a long story short, nothing that we've seen this past week causes me any concern whatsoever as it relates to 1990. It just doesn't. Now, the second reason why I think we're going to rally is because when you have an inverted head and shoulders pattern, there are a couple of rules, if you will, for how to trade these. And these are not my rules. These are rules that were noticed by technical traders in decades past. And where I read about them was in a book that was originally published in the 1950s. This book is more than 60 years old. And this is how the trading rule goes. Upon a breakout from an inverted head and shoulders pattern, and here's our inverted head and shoulders pattern, and here's our breakout, you enter a long position. Now, that is not me commanding you to do that. I'm just saying, I'm reading you the rule. Enter a long position upon the first of these three things that happen. A return to the neckline. We have not done that. B, a return to a 40% retracement off of the end of the breakout move, which we now know where that is, measured from the bottom of the right shoulder. So I've used this Fibonacci retracement tool right here, and we end up with that 40%, or in fib levels, that's 38.2, same thing. You end up with a level right at about 1920. Okay? The third thing is return to a trend line drawn from the extreme low of the inverted head across the low of the inverted right shoulder. So what that effectively does is that puts us into a situation to where these teal colored lines, let me scoot that one just a little bit, represent the buy trigger according to John McGee in Technical Analysis of Stock Trends. That is the that is the book that was written in the 1950s. So that means if we continue to slide down a little bit, then the buy should come at 1920, or if it's even if it keeps going longer and longer and we're really lazy about it, wherever this line might be tagged right here. So all of that to say, according to John McGee in Technical Analysis of Stock Trends, this little slide really has got maybe 15 more points to go before it becomes a textbook buy. It is possible that we don't make either of those. It is possible that we rally before we ever see either one of these lines tagged. That's why I have this line right here. So, to make a long story short, as far as the week went, we started the week with a nice move up over 1955. We know that we have the market has demonstrated its legitimacy in the 1900 level, and it is not unusual to see a pullback. So once we came down and broke this line right here, we figured we would probably be in for a few days of weakness. Now, one thing I did on the last video is I have put down another speculative, underline that word, I've put down another speculative channel. And these are these two orange lines right here. And the reason I did that is I looked back on the chart and I started to look at some of the rallies that we've had in the past, and I noticed that this line right here, if we create a parallel line, has a tendency to line up with a lot of the action that we've seen in the past. It just seems to have defined, particularly back in last fall. This really was a helpful trend line. So just kind of with that in mind, it hasn't always worked, but it is not as aggressive as that red channel. And I think again that red channel was just going up at too much of a slant for that to last for a great period of time. So you see, we went up for about 3 weeks at a really strong pitch. If we look back in the market in the past, about 3 weeks is the longest we've ever been able to sustain one of these brisk moves off of a bottom. Here's one right here. Back last April into May, that one lasted about a month. Then we had another one in June and July. That one lasted about 3.5 weeks. This one here about 3 weeks. This one here again about 3 weeks before we started going sideways. And again, we've got about 3 weeks right here. So all of this to say, this little slide doesn't bother me. I think it is still a good idea for us to keep 1990 in mind. So I'm looking for that target, and I think this week we'll find out where our more reasonable support line exists in a channel that is capable of sustaining a move that is less aggressive than what we saw over this roughly 3-week period, but along with being less aggressive, more sustainable. Let's take a quick look at a couple other things. Looking here at the Dow Jones Industrials, I just want to show you real quick. There's been some talk about maybe a wedge forming here, and that is possible. But I just want to point out that if the wedge were between here and here, there's still plenty of room. Wedges cause a breakdown in price because it gets to the point to where there's so little profit in the trade that people just don't buy. If this is our wedge between this line and this line, there's still a lot of profit to be made coming off this lower line and going up to the top line. And for sure, between here and here. Now, one thing I do want to point out, and this is very interesting, as you can see here over this 9-day chart, that the Dow Jones Industrials over the past 14 years have made a sort of a broadening pattern. Now, you may say, well, I hear that broadening patterns are really nasty tops. Well, they certainly can be. The sad thing about this, and if we back out, let's say, to a quarterly chart, the sad thing about the size, maybe a monthly will do better. There we go. The sad thing about a broadening pattern is that it basically works something very similar to a head and shoulders top. And that means, and this is why this pattern is going to be nearly untradeable unless it gets confirmed. But when does this become a confirmed broadening top? It's when this line breaks. So guys, that would mean we would not know if this is a broadening top until the Dow gets under about 5,500, and that is that just getting there would be catastrophic as far as the markets go. Now, what about this top line? Well, we are getting somewhat close to that line. As a matter of fact, we are currently a little bit over it. So I think that certainly bears watching, but you can see that the Dow has been setting new record highs. And again, if we look at our potential wedge shapes, this would be a potential top line here. Here we are sitting at 16,775, and tagging the next top line could be about 1,100 and change points in front of us, which is plenty enough for buying interest to be present in this market. Now, if we break this blue line, then I think we do need to step back from this a bit and say, what's going on here? Okay, so far this blue line has been essentially rock solid with our original touch back in March of 2009, again in October of 2011, November of 2012, October, almost October of 2013, not quite, and then this touch right here, which was back in, what month was that? February of 2014. So this looks maybe a little scary if this line breaks, but right now I see a likely resistance up here at this line, which is currently a good bit over 17,000. Quickly, let's take a look at the Dow Transportation Average. Sort of a similar picture. You can see this resistance line right here, but how valuable is that? I'm not sure. So I would watch this line in the transportation average, because this is the long-term support line. It's interesting to note that really the S&P has been the healthiest looking of all of the of all of the indexes that I can think of. Then we've got the NASDAQ. You can see the NASDAQ looks like it's coming off of support. So I guess what I'm saying is, clearly in the major indexes, nothing is broken. Not yet. Will something eventually break? You betcha. It most certainly will. But so far, nothing has broken. This wedge shape to things, should we keep that in mind? Absolutely. Okay? I believe eventually all of these wedge shapes will come into play. But we knew about these wedges back in 2011. And had we gotten scared out of the markets back then, we would have missed a lot. So I would say wait until something breaks. Don't look at this and go, oh, geez, that's a wedge. I'm getting out. Well, I just don't think that's the right thing to do. I think the right thing to do is say this is a wedge, and a wedge is confirmed when the lower support line breaks. So wait for the break. Until then, enjoy these rallies. So for right now, since we follow the S&P, I think what I'm going to do is I'm just going to keep looking for 1990. If we tag 1990, that may be a time to pause and reflect. Maybe look at some of the other indexes again and ask ourselves, is that a good spot to maybe lighten up or sell? Because it could be. So look, guys, I appreciate you taking time out of your day to watch this. I want to thank you for your support, and let's see how things go this week. Maybe we learn a little bit more about this broader, less aggressive channel. Maybe we find out that was a good idea. Maybe we find out it was a terrible idea. I'm kind of thinking it's probably close to the idea. So let's see what happens tomorrow. Thanks again for watching. Take care.